Good evening. Great to be back with you. My name is Peter Resnicek from ShadowTrader.net. This is another edition of the ShadowTrader Video Weekly for Sunday, July 18th, 2021. This video, I want you to treat it like a training video. It's not really a training video. I've got lots of training videos on YouTube. You can look them up on options, futures trading, market profile, etc. But I hope that the takeaway from this video is that you think of it as a training video in a way that it will give you a framework or a checklist, if you will, of all of the things that you should be looking at. And the more you trade, the better you'll get at this, and the faster you'll be able to take in all this data within, say, 5 seconds. But I'm going to give you this whole checklist, if you will, of things you should be looking at so that you can make a decision as to whether or not the market is actually bullish or bearish. And I thought this was the perfect thing to talk about at this juncture because the market sold off quite hard on Friday, closing near the lows of the session on the S&P, but contextually to me it didn't seem all that bearish, or at least not all that bearish yet, and hence the title of this video, which is very important, Don't Panic, and then in parentheses, yet. And I think it's very, very apropos. When you get through the video, you will see that. This video is all about context and trying to get people to take their attention away from price, because remember, what is price? That's right. You in the back? Yes. Advertising mechanism. Thank you. ShadowTrader coffee mug for you, sir. Price is an advertising mechanism, okay? That's all it is. It's just, look at me, buy me, sell me. I'm cheap. Buy me down here. I'm expensive. Sell me up here, right? But it doesn't have a lot of meaning without context, okay? It's just really a number. And a lot of times people just kind of focus on that. They'll just keep their vision in terms of what they're looking at on the charts. They'll just watch the S&P and they just see it plummeting and they think that's all there is to it. But without context, it's not very meaningful. So this video, I hope, is going to give you a lot of context and help you out a bit and give you a lot of tools that you can take into next week so that you can be more objective and get a real idea for what the market is actually doing or not doing, and to help you to trade accordingly, I hope. All right, without further ado, let's get into it. So in order to keep it as objective as possible, what we're going to do in this video is we're going to go through almost like a checklist. You can write it down if you like, if it helps you in your own trading. That, of course, is my goal here. But we're going to go through a lot of different things that I hope are going to keep you objective. And we're going to deal a lot in what I refer to as signposts. You've probably heard me use this term before in videos. I use this term constantly in my options advisory when I'm sending messages out to people in real time saying, you know, what are the signposts that we need to be looking for that are going to tell us if things are bullish or bearish? It's so important in the markets to pay attention to context and not allow ourselves to be seduced by price. You know, being seduced by price just simply means when you're just staring at price on the screen, all you're looking at is like just the ES and it's falling and you just see it falling, but you're not paying attention to any sort of context as to where that ES is in relation to the prior day's low, the current day's low, half back, right? What is the midpoint of the prior day? What is developing half back? Perhaps market profile nuances. Then you move to internals. It just, you know, it can get as deep as you want and as nuanced as you want. And the more data points that you put together before you make a decision, the better a trader you'll be. So one of the first things that I look at, very, very simply, I keep everything as simple as possible, is just simply where are we in relation to moving averages? And I don't like to change my bias unless the 20-period moving average is taken out, meaning unless we trade below the 20-period moving average, like here, it's more of a bearish stance. You know, and as you can see, obviously the market's been bullish for quite some time. So we've never really spent a lot of time below the 20. Like let's say here, this was a good amount of time below the 20 MA. So you'd want to bias yourself more to the short side then. But again, if we look at the S&P, just using simple moving average of the 20 period, and these are really the only two I look at. I look at the 20, I look at the 50, and I look at the 200. But most of my analysis centers on the 20 and the 50. Question you have to ask yourself is, are we still above the 20? As you can see in the SPX, we are well above the 20. Let's move over to the NDX. Same exact thing. We are well above the 20. We have a little bit of room to go. And again, there's just no reason to change bias unless we get underneath that 20. Now, when we move over to the Russell, which I often refer to as the wild card, it has lost the 20 a while ago, and it's actually threatening to have a cross. Some people call that a death cross when some moving average pinches through another one. I don't really use that term much, but there is definitely potential here of a cross of the faster moving average of the 20 going through the 50. And as you can see, the rut has been short-term bearish for some time. And when I show you what I'm doing in my options advisory, what trades we've got on currently, you'll see that we are actually bearish on the rut, looking for a little bit of a further move down. So the rut is technically on the most short-term signpost, for lack of a better word, right? What is the most short-term data point that we can look at, which would be just the moving averages. The Russell actually is trading underneath while the other two are trading above. So now the next data point that we want to look at in terms of judging, how bullish bearish things are, and again, in keeping with the theme of the video, because remember the theme of the video is don't panic yet. So there's nothing really to panic about now, even though obviously we closed at the low on Friday, as I was discussing in the introduction. But let's look at these trend lines. And for trend lines, you really want to go out a little bit further in time, looking at a weekly to give yourself a better idea of where exactly you are trend-wise. So if we look at this, we could draw it in a couple of different ways. We could start from where we are there, or we could have like a swing out method like this. And that doesn't really work because you notice that if you go to here, you can make the argument that we broke trend, but this isn't really a trend line break. We've just sort of been riding trend since this period. So I'd prefer not to draw the trend line from the lows. So I'll just get rid of that one. And I draw it here from this low here. You could even just draw just these 2 points, but regardless, however you're looking at it, you can clearly see that on that weekly, you do not have a trend line break at all. The trend is intact, and I'm paying attention to this prior high here at 42.56.55, where there was a shelf. This is very important. These areas of congestion often draw price back to them, and then it'll act as a potential bounce point, if you will. So again, just looking at the SPX, no change in trend whatsoever. Now, flipping over to the NDX, and we can draw the trend line from the lows there. Notice how beautifully it's supported here, and yet there's so much space between here and the trend line. We are totally just fine in the NDX. This is a very minor pullback. We haven't even taken out the prior week's low, so again, there's no panic situation in the NDX, and the rut wild card, as always, is always looking different, because notice that if we look at it on this weekly chart, it actually is just now, if we look at the same two anchor points, starting to break the weekly uptrend. And this is important because oftentimes the rut will be in a leadership position. So, should be very, very interesting. So we'll see if indeed this rut is actually going to be acting as a leader, taking prices lower, or if it's acting as an anomaly. We shall see. All right, now let's take a tour through the 11 sectors of the S&P real quick. Because think about it, if we're getting more granular and we're trying to put together as many data points as possible as to whether or not the S&P is going to rise or fall, then it makes perfect sense that we would look at the 11 sectors that actually make up the S&P, because the SPX price itself is made up of nothing more than the 500 stocks that are in it, and those 500 stocks that are in it are in these 11 groups. So let's just start with XLK. It's obviously the heaviest weight in the S&P. It's going to look a lot like the NDX, obviously. So again, where are we in relation to the 20 MA? Plenty of room there. Could we strike a trend line? That's obviously a very ugly trend line. I failed art as a kid. But you get the picture. We're well above trend, plenty of space between there and the 20. So really nothing major going on in technology. Let's shift to the next one, which is XLV. That's healthcare. I found it very interesting that on Friday, healthcare actually had a pretty bullish candle. It gapped up and held. And notice that it's really just a consolidation within range, way above the 20. It's like there was almost no give back in the XLV. It was one of the sectors that was actually green from the open. For most of the session. Let's take a look at another one here, industrials. XLI, a little bit weaker, and it is just starting to be underneath the 20 a little bit, just peaking, and this does look a little bit like a rollover scenario where you have a long period of consolidation where a new higher high was failed to be made, so there was no new higher high here, and there is potential of rollover here. The moving averages are still pretty sideways, but I would just keep an eye on that one. Industrials do look like they're slightly rolling over, and that's about 9 to 10% of the S&P. Let's go on. Let's look at financials. Oops, let's type if we could, XLF. Okay, it looks very, very similar to industrials. I found that these two sectors kind of oftentimes will look alike. Long consolidation here, just underneath the 20. Hard to say which way this goes. If we look at this and we break it up into thirds, we can make the case that we are now in the lower third here, right? Or in the bottom half here as opposed to that. So it's a little bit more bearish. We shall see. But, again, potential rollover scenario, we'll keep an eye on it. But definitely not all out bearish as of yet. Consumer staples. Great day on Friday. They actually gapped up, held, sold off back to the open, but held, but certainly way above the 20, way above the 50. Nothing bearish there in staples. Let's look at consumer discretionary, XLY. A little bit more bearish, breaking down a bit, but again, no loss of trend as of yet. Still way above trend, but just starting to peak down below the 20. Let's go on with XLE, energy. Energy has been weak over the last few sessions, but it's important to note this is not a big representation in the S&P. Things have changed now. The sort of baton has been passed. Things have shifted, and it's all about tech and healthcare, financials, industrials. The big weight of energy, it's not there anymore. You don't have an ExxonMobil anymore, for instance, as the most valuable company in the world, right? Now it's an Apple or whatever. So things have changed. So the fact that this energy is weak doesn't really add that much to the calculus here because energy is only making up a couple percent of the S&P. So that's XLE. Let's take a look at real estate. Also not a big heavyweight, but we'll look at it anyway. Real estate very, very strong. Obviously, bond prices keep going up, which means that rates keep going down, and that's of course acting as something very, very buoyant, for lack of a better word, for the real estate sector. So you see that strength in the XLRE probably on the heels of those low rates. Materials, definitely bearish, not a big player in the S&P, but I would say this is probably one of the most bearish sectors. This is one that I actually got wrong. If you recall, in past videos, this is a setup that I talked about where I thought it would break to the upside because I loved the consolidation, how tight it was, and it kept making peaks in the same exact area, and I thought, okay, this is going to go. So we'll see. I do have a ratio spread on of the XLB. When I get to trades I have currently on, you'll see it, but this is definitely not working. Again, a little bit more bearish, but not a big heavyweight in the S&P, so I'm not that worried about it. And last but not least, XLU, utilities, which are strong, however, not a big weight in the S&P, but also you don't really want to see them strong because they tend to be very defensive. So this actually, the fact that this is strong is actually more of a red flag than a green flag. So I would watch this prior high in the XLU. You don't want to see this really breaking out. That to me is more of a sign of a risk off scenario where money is moving into a more defensive sector. All right, let's look at some other stuff. I call this section here internals, volatility, bonds, and market profile. So we get a little bit deeper and deeper. We just keep adding more and more layers, give us more data points to give us an idea if things are bullish or bearish. Obviously, with internals, we really only focus on the day, correct? On the day in question. But here's some things to look at to keep it in context, and I think this will be helpful to you. Breadth was not that bad. It certainly wasn't all that bad on the NASDAQ side of things, but on the NYSE side of things, that's a pretty decent number. To end the day 5-to-1 negative, pretty bearish. You can see here the pictorial representation of it with the candles. You can see it's much lower than the prior rest of the week, so that's important. This one here is ADSPD, which is the advanced decline line on just the S&P. So basically it's just those 500 stocks and advancers minus decliners on those. You can see we closed at minus 186. Okay, that's not that bad. That could be much worse. Look at down here. Closed here, 361 of the 500 stocks were down rather than up on that day. But this is interesting as well. Friday made a fresh 2-day low, well below the Thursday low. And yet, look at the relationship on Friday of advance decline and on Thursday. It actually was worse on Thursday at the open. And here at the low, this is really the true low of the day, because a lot of times this open can be very distorted on a gap. You get a gap down and you get all the stocks in the S&P gapping down, and it just registers a very low number early. I don't put a lot of weight into early internals. A lot of times you want to wait 5 minutes or so, 15 minutes before you start to get good internal readings. So consider really that this is the low of the day at about the same 186 to 200 on Thursday, and then look where it closed on Friday at the same 186, right? Or, roughly 200, 186. I don't know the exact number here. I don't know the exact number here, just that the close is 186. This is interesting because this tells you that even though price as a whole was going lower, under the hood, the stocks weren't as weak, right? And this can, of course, happen because remember, the S&P 500 is capitalization weighted. So if some of the names that had more, higher capitalization were down, obviously that pushes the price of the index down. But I'm saying if you look at the relationship between advancers and decliners, it was the same as it was Thursday, yet price went lower. So not as many, it wasn't like more stocks were going down on Friday. So I think that's noteworthy. Looking at ticks, and again, we're looking at just kind of very recent Friday. This is kind of bearish, I would say. This is one for the bears. A 5,000 cumulative tick is pretty weak, and definitely you can see the acceleration in relation to Thursday. But one thing that jumped out at me, and I kept pointing this out to my subscribers on Friday, was where was the minus 1,000 tick? It didn't exist. It wasn't there. There was no minus 1,000 tick. If the selling was stronger, you would have registered many minus 1,000 ticks. Remember, on a trending day down, you would expect that to register anywhere from 3 to 5 to sometimes 7 or 8 minus 1,000 ticks, and we didn't get a single one. The low tick of the day was 975. So I think that's kind of that's somewhat noteworthy. So I kind of just kind of add this all together. Again, remember, these are all data points that we bring together to give us a better idea of bias. Let's take a look at volatility. This also, to me, did not really accelerate like I thought it should accelerate in terms of range. Notice that where the volatility peaked on Thursday and then where it went Friday, it was just a little bit higher. Again, I'm not trying to talk, all bullish or saying nothing's going on, but when I look at every data point, this could be much worse. This could be much higher. Why didn't the VIX rally, all the way up to here? I don't know. It just doesn't feel to me like there's all-out panic going on. Let's take a quick look at bonds. The strength continues. This, I will say, is a more bearish signal. You have to ask yourself the question basically over and over, if the equity market is so bullish, why is the bond market disagreeing, right? Why is there this sort of flight to quality, this sort of risk-off environment where long treasuries are constantly bid, which is obviously causing interest rates to go down. TNX is something we watch closely, just keeps going lower. This is noteworthy because tech likes this. Obviously, this is generally bullish for tech. So if you start to see tech softening, even with these low rates on the 10-year being accommodative, that also is a tell. So just another data point that you would want to put together. And last but not least in this section, market profile. Of course, my favorite part of all technical analysis. The profile has just been great lately. I've gotten a lot of fantastic compliments, for lack of a better word, from people who read my Peter's Pre-Market Perspective every morning. Remember, if you sign up for our options advisories for either the weekly or the time spreads, that's the advanced or intermediate, you do get the Peter's Pre-Market Perspective for free. If not, it's only $20 a month, and you can take a 5-day free trial. But it's been pretty spot on lately. I've been really working hard on my objectivity lately and trying to really just write about exactly what I see. Remember, I'm writing this in the pre-market, so this is important to note. This report is written before the market comes out, and I give you scenarios of how I think the day is going to play out, and most importantly also, what are the exact key levels that you need to be looking at. So here we're looking at the profile, obviously, after the market has done its thing, right, as opposed to before the market. So what we can look at, really, once the market is closed, is we can kind of deal with structure. So let's just look at the facts as they are. This is a 3-day balance area. We call that a balance area because the ranges are relatively similar, the value areas were the same, and interestingly enough, we had 3 POCs, 3 points of control this week that were almost identical. That means that that is the area where the most amount of volume traded in those 3 sessions, and it was almost identical. And this was an area that I was calling out a lot in the in my pre-market perspective, telling people to sort of play against it, look for prices to be drawn to it, a little bit of overhead supply if we're below it. It's no surprise that this overnight session here, notice where it peaked. It's very interesting. This is the high volume node, and yet the overnight session tops out right here. And then look at where the regular trading hours session on Friday peaked. It couldn't even get that far, but it started to stall very quickly as it got close to that area. This is noteworthy. So looking at the profile on Friday now, and again, keeping with the theme of don't panic, not yet, this is not that bearish because look at how thin the profile is here, all at the bottom, which indicates kind of a late day acceleration of selling, and yet all the value, all the time was really spent here, okay? Plus a lot of single prints. This is a lot of single prints, very emotional selling, very knee-jerk. We did get a volume point of control migration to the bottom, and we had a close at the lows. That's bearish when the greatest amount of volume is traded in the lower part of the session. So that's something I would put more in the bear camp. But time-wise, not a lot of time was spent here. You don't really want to see the profile skinny like this, and you generally don't want to see a close at the end of that skinny part. That's usually the type of thing that reverses itself overnight, and we'll see. Sunday night is going to be very important to watch very closely to see how much of this thin area gets retraced. If none of it gets retraced and we move down aggressively on Sunday evening, of course, that's a huge piece of market-generated information that's going to tell you a lot. If we find acceptance above this level, more in line with where value was on Friday, that of course tells you a lot. This is essentially how you use the market profile, is you find those areas where people traded emotionally, find those areas where people traded more rationally, where they supported the bid or put their trades out on the offer if they wanted to sell, as opposed to these single print thin areas where they didn't act that way, where they acted emotionally and they were more just hitting the bid at market in either direction, basically. So this is important to note. So we've got some nice signposts here to look at coming into next week. We did have a gap fill, which was here, so I will take that off. That is no longer needed to be there. And what have we got down below us? Next is going to be this VPOC. This is a virgin point of control at 43.09. So if the market moves a little bit lower, we're probably going to see the 43.09. And then I've got some very interesting references down here, but this is kind of far away still, and I don't want to get too into it, but there are more gaps. There's a number of more virgin points of control. There's a weak low here, etc. There's some nuance there as well. But again, we're just kind of dealing with what we see and dealing with what we have right in front of us and trying to get more of some color, so to speak, on what Friday was telling us as far as the market profile is concerned. And of course, last but not least, it would be disingenuous if I didn't tell you exactly how I was handling this market, at least what I'm doing in my live trades with the weekly options advisory and what's been going on thus far, what we have open right now. Not overly heavy. We closed a lot of trades today, leaving us with about 4 or 5 open. 5 actually, the ones you see here. Most importantly though, in terms of potential bearishness, I want to show you exactly how I'm playing it. It's these 2 trades right here, which would be the S&P here, that's open, and the IWM here. So look at the spreads that I have on and look at the cost. And you can see that it's kind of tentatively bearish, and it's also exactly the way that I like to play directional moves because I don't like to put out a lot of debit. And when I do put out debit, I like to scramble to get that debit back. So perfect example of that would be this Amazon earlier this week. I was actually bullish on Amazon. I didn't think it was going to fall apart as it did. So what did I do actually is I very simply bought a butterfly on Amazon, and that was in here, which you can see I laid out debit for. That cost me $4.50, right? But at the same time, I sold some put credit to pay for it, only half of it. You can see obviously that the debit was 2 times what the credit was. But then, which I thought was a pretty cool move, was as I realized that it was falling apart, I just sold more call credit inside of the middle of the butterfly. Since I knew that I had a 3750, 3800, 3850 on, which was 50 points wide, right? I've got this huge area of profit. I figured, you know what? It's perfectly safe to add more units of short inside the butterfly because I've got that 3750. So you can see that this stuff here just sort of netted out, and I was able to get all of that debit back. And then on top of it, I've started to harvest some of those ratios for credit, which I put on for a credit and then took off for another credit. So this is actually turning into a more bearish play right now because the only thing that's on is the put ratio, long the 3450 put and short the 3300 2 times. As far as indices, let's look at this IWM. I think this is a fantastic trade. I was really happy with it. It's actually expanded quite a bit already. I think it's trading about $1.80 right now. We put it on for $1. Basically just a very wide bearish butterfly. I thought the price was fantastic because notice that there's $8 of potential gain here and we paid $1 for it. So I really liked the price. I thought it was great. It's a little bit broken wing, but it's not broken wing so much in any way that there's any downside risk. Obviously, you can do the math, and there's a little more distance between 207 and 197.50 than there is between 215 and 207, but just a tiny bit. So even if IWM was to crash through all of these strikes, this would still be a huge winner. So it's fine. There's really no downside risk there. And then the S&P, in the weakness on Friday, I said, okay, it's nothing to panic about as of yet, but the time to have bearish trades on is when? Is before the panic sets in, right? So same exact thing. Relatively wide butterfly, did it as a BWB. Notice the cost. The market paid me 10 cents to put it on. So I took in a tiny credit to put it on, 4 units, and then I just tightened it up a little because I thought, well, maybe a little bit too much downside risk. So I just bought the 42.25, 42.20 to kind of tighten up that the bottom of that broken wing butterfly. So now I've got about $10 worth of risk to the downside total if we were to blow through all strikes, but also with a $15 potential upside if we were to come into the 42.55 strike. And as always, as I like to say always, there's a method to my madness, right? I never ever just put on butterflies without clear targets. It's very, very important. So let's just take a look at that SPX really quickly. Why do I have a mid-strike on a butterfly at 42.55? Well, look at the prior high. Where did we break out from 42.55? And where's the 50 MA? It's right there. So if the market is indeed going to come in, this is where I think it's going to come into. There's also the trend line support here. So what's the best case scenario for a butterfly is you obviously want it to be in the mid-strike. So you want the market to come down to an area where you feel there should be support. Here, obviously, there's a confluence of support. Makes perfect sense. That's the spread that I want to be in. All right, same thing with the IWM. Let's take a quick look at the IWM. Remember, the Russell is weaker. I actually put on the Russell trade long before I put on the S&P trade. And look at the support here. Where's the support going to come in? It's going to come in at 207 to 208. And if you recall from the last screen, right, where was the mid-strike on the IWM butterfly? It's right here at 207, right? The mid-strike is at 207 on the Russell, on the IWM. So again, that's where we want to be. So it's very, very important, I think, to use that, use your technical analysis in coming up with your options trades, and you'll just have a much, much better outcome. But that, in a nutshell, is where I am at going into next week. Basically 3 bearish trades, but with the caveat that these bearish trades didn't cost me any money or just cost me very little money. I can easily adjust that debit out like on the IWM if I need to, but so far that's working out well. Couple of bullish trades. I thought Disney looked great. That actually completely fell apart on Friday. But again, look at how it's structured. Yeah, I was bullish on Disney, but I paid 15 cents a contract. This is actually a typo here. It's actually 15-cent debit. There was a little bit of an error there. So again, yes, I was bullish, but how much did I pay? Almost nothing. So if DIS goes to 0 or it doesn't work out, no problem. My loss is minimal. That's my number one MO in my advisory. Keep losses small. And I mean, for what it's worth, the proof is in the pudding. The track record speaks for itself. I keep losses very small. You can just go through this whole thing and you see the size of the winners and then you look at the size of the losers. The losers are all very, very small. And that really is the trick, I think, to successfully having some consistency in the market, is making sure that those losers are not big, because they're the ones that can hurt you. Outside of the DIS, I do have a bullish thing on in XLB. I talked about that already. That's not going so well, but again, it's a relatively small debit, and I purposely put my duration out a little bit longer, out to the 30th, to let that work out and give me some time to make some adjustments if I need to. So there you have it. That's exactly how I'm positioned going into next week, what exactly I'm looking for. Obviously, this can change on a dime. I make tons of adjustments and trades live in real time that I send out to people's phones all the time. You can see the URL right there on the screen if you want to join us. So this obviously is a work in progress and changes every time. But for the purpose of this video, for a weekend wrap-up as it may be, gives you a very good idea of how I'm feeling, how I'm positioned. Sometimes you can get a very, very good idea. I shouldn't say sometimes, basically always you can get the best idea of how I feel about a market basically by this spreadsheet. How I'm positioned, what types of trades I'm feeding to my subscribers, how many of them are bullish, how many of them are bearish, how aggressive they are in each direction. I talk about this all the time. If the market is straight up bullish, I'm willing to pay more debit, and I'm probably doing 100% risk reversals, right? It's going to be all, and I'm using verticals as opposed to butterflies. I'm trying to capture more delta basically, and I'm willing to sell puts naked in order to buy those verticals so that if it goes nowhere, I break even. But it's a very aggressive stance. It's a short put, long call stance. That's not the situation right now. It's more of a sideways to middling. We got earnings coming up as well with Fangman plus T. That takes a lot of those names out of the picture for me at least, right? So you see what I'm doing. I'm not all out bearish. I've got a couple bearish things on. I've got a few bullish things on. It's kind of a mix. Nothing is big debit as well. So if it doesn't work out, okay, we just move on. We more or less break even. This is very, very important. If you want to know what I'm doing during the course of the day, if you want more from me, if you feel these videos are helpful, this is how you can get it. It's very, very reasonable, 49 bucks a month. Hit the link down below that you see in the screen, and you can get my live trades as they're unfolding, and more importantly, get all of the alerts that I'm sending out every single day, all day. What's Peter thinking? Audio messages, snapshots of charts, trend lines. Hey, look at this. Hey, look at that. This is where you should be focusing. Constantly keeping people's attention on context and process and where they need to be looking so that they're not just seduced by price and they're not caught in that loop of shock and awe, which is really what can destroy you as a trader. And that's all for this week. Thank you, as always, for spending just a little bit of your weekend with me. On behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, as always, I wish you good trading and good night.